Because believe me, I've never ever heard the truth on television. Never. When they give you these newscasts, what they're telling you is probably basically true, but they never finish it off. They never tell you the truth. Probably they don't know what the truth is anyway. Because if the market plummeted down one day after some sort of fall, and somebody's gone bankrupt or something, or somebody's, in real trouble, they will give you all those details because there's no news in good news. There's only news in bad news. But if they were telling you the truth, they would end the broadcast saying, well, however, don't worry, because we've got people on the floor that are telling us that all the professional traders are busy buying this. Now that will make that strong, not weak, as in news is inferring. They never tell you that ever. As far as I'm concerned, the only thing that concerns me personally, Gavin talks about this and that and all the rest of it, but from my point of view, what you must learn is to identify the principles that will shift the market. And then you have to sit there, and your skill as a trader has to find these different time frames. Now, what's interesting is that there's only 3 principles, only 3 that make the market fall, and only 3 that make the market go up. So you only have to understand and learn 6 principles, which surely, that's why I always find it difficult, people can't understand it. So you've only got to understand 6 principles, and if you can learn and identify those, you will be 90% there. I can tell you that now. And so there's only 3 at the top and 3 at the bottom that you need to be able to recognize immediately. Now, of course, when you look at the chart, you look at chart there, what it is, it's speaking to you in a language of high, low, close and volume. So you have to learn that language. And to do that, you first of all have to realize that the market, when you look at the volume below the chart, right, what you're looking at is the professional amount of activity that's taking place. Now, this is great news for us because we don't have to worry really about anything. You can see the volume in 1 or 2 seconds, right? If it's high volume, right, then you know the professional side of the market is active. If it's low, then you know the professional side of the market is not active. If it's just average, well, it's just average. But the beauty of understanding volume, you'll be very few people, I might even say in the world, that understand what we're telling you about volume. There's all this clever stuff on balanced volume. The computers can say they can identify buying volume and selling volume. That's all misleading for you. That's only going to cause you trouble. Because as a professional trader, you look at the chart and within 2 seconds you know whether the professional money is active or not active. This is the key to it, the volume there. You can ring up, if you've got contacts, you could even ring up friends on work on the floor, professionals. They won't help you because they can't help you. Because when we look at the volume, we see what we call a consensus of opinion amongst the professional money. Because all these professional traders, they hate each other's guts. They don't talk to each other. I can assure you that. They're in competition with each other. But what they can't hide is their activity. And that's what we're looking at. So when you look at that volume at the bottom of the chart, you can see in 2 seconds whether the activity is high or whether it's low or whether it's average. So that's a great advantage. Very few people, I've never met anybody that can tell me that properly what volume is. And then the next step, of course, is on that activity, what effect does it have on the price, the market? And that's where the key is. So you've got the activity, which doesn't mean anything. It just tells you whether their professional side is active or not. Now, admittedly, when you look at the volume, it's a consensus opinion. It includes all the trades, Sebastian, mine, Gavin, yours, everybody's. But the thing is that because we know that that volume contains at least 80% or more of professional activity, that's all we're interested in. That's why we don't need precise figures to go on, because we use relative volume. And you could be several million out. It doesn't matter to us. We want to know whether they're active or not active. And the next principle then is you look at the actual formation of the bar on that volume, keeping in mind that when weakness does appear, it will always appear on up bar. It has to, because they have to sell into the buying coming in. Right? That's the only way they can do it. And also on the bottom, they have to buy into a bout of selling, and they absorb it. That's how you get rock bottom prices. They can't do it any other way, because the market makers on the floor and the specialists, they know who all these professional traders are, and they'll simply market up against them. If they see you're buying or selling, they'll market against you rapidly. I know they do that. So that's why there's so much secrecy, skullduggery going on, rumours, all sorts of things. Volume is the key to it, without any question of doubt. You can see how valuable volume is. You take commodities, they won't give you the volume for the next day, which is absolutely ridiculous. Now the days of computers and everything. And even as Philip Friston here will tell you, he specialises in the FTSE, you can see they can hold the volume up for 2 days sometimes. But because we're looking at relative volume, it doesn't make a lot of difference to us as an analyst, because all we want to know is, are the professional money busy? Are they not busy, or are they just average? Keeping in mind that when weakness does appear, it has to appear on up bar. So if you see an up bar and the volume's high, especially if they've gapped it up and the spread is narrow, then there has to be serious signs of weakness. Gavin loves that signal. We call that the end of a rising market. And the reason it works is because you can see the terrific activity. It's probably been gapped up deliberately by the specialists or market makers. But when the spread is narrow, especially if it's a new high ground or fresh new ground, the only thing that can cause that is something's capped the top end of the price. And the only thing to do that is, if you're professionals, you're selling busy everything into the surge of buying. And that's why it's a sign of weakness. So that's only one sign at the top. There's only 2 others. And if you just sat there and refused to trade, unless you saw these principles, then you'd have to be a pretty poor trader not to make money, or not to lose it anyway. I mean, I say jokingly, you know, if you're standing in a bus queue, you're waiting for your bus to come along with your number on it. There may be lots of other buses, but you ignore all those because you know there's only 3 principles involved. Now we know we're right because we have a computer software that will bring up these signals with what I call uncanny accuracy. And the computers don't understand flaws in your logic. They simply just don't know. We've got an IT gentleman here who'll tell you that they just don't understand it. If you put telephone number in, you've got 1 digit wrong, nothing happens. So the fact is that the signals, even on a 1-minute chart, are uncannily accurate. Shows that that is the principle that's driving the market. Otherwise, the computer would, you have signals all over the place, just looking silly. So anyway, we've described one of the signs of weakness that you have to recognize, which you will recognize, right? And of course, the other 2 for the top is that when you see some dramatic signs of weakness, not always, the market may start churning and going sideways a few bars. And if it starts going up, back into that area where you first saw the first sign of weakness, and you notice that the volume is low, that means that the professional side of the market is not interested in that up move, which has been marked up by the people in the cash market. They're not interested. Why? Because they know it's weak. Why should they be interested? That's what we call no demand. And if you see that bar go up into that area, and the spread is narrow, closed in the middle, the volume is low, you can short that without any fear at all. Right? So that's two. That's only two. Now the third one, of course, is the upthrust, which we joke about. The upthrust can appear sometime after. They mark it up rapidly, given the opportunity, market conditions, triggers off thousands of stops usually above the market. Above and below these actively traded markets, there are thousands of stops. And it's very, very profitable to trigger these stops off. And of course, you encourage people to go long. You encourage people that are already short to panic and cover and so on. So there's only three principles at the market top. You don't have to worry about anything else. Now, how easy is that? It can't be easier, can it, surely? Now, at the bottom of the market, right, to stop a down move, a bear move, you have to have what we call climatic action. In other words, stopping volume. Some terrible news will usually appear. Everyone's going bankrupt or something wrong. Remember, there's no news in good news. All the news is always bad news. You never hear of good news. Very, very rarely do you hear good news on the TV. Because good news is not news. Bad news is news. And they do the same thing in the market. The market plummets down, everybody's panicking. But you, because you can read the chart, you can read the book, you see the volume's massive, it's probably closed in the middle, down into fresh low ground, that's stopping volume. Now you can jump in and trade that, but we always say, once you recognize the principle, then I'm afraid your skill as a trader has to take over, because we can't actually tell you how to trade. And we wouldn't want to, and you really wouldn't want us to tell you when to actually trade. Now, okay, so you've got your stopping volume, climatic action. I was looking at Barclays Bank, I think yesterday, and sure enough, there's a huge climax right on the bottom there. Just what I'm telling you, massive volume on the downside, but there's so much stock transferred that it didn't have to churn like Gavin was talking about, it just more or less went straight on up. They only churn the market because they want to accumulate more. But when the news is really, really bad, like there was a meltdown and all sorts of things, then the fear is so much that everybody gets shaken out. Don't forget it occurs after you've seen a down move. So you're already under great pressure. And then that's the final blow when that terrible news comes out. But you know professional money has said, right, thank you very much. We'll take it if you don't want it. We like this bargain price. And you can see they've done that because the volume is massive. It's probably closed in the middle. If the spread is narrow, then that adds more strength to it. So that's only one principle. Now, the only other principle you need to be concerned about is if the market starts going up, but there's a little bit of no demand, it's not no demand because you've got strength behind you. See, I must emphasize this, that these principles only slot into your analysis like the signs of weakness, if you've got weakness in the background. Talked about no demand, talked about the pound, which I like. I've seen the pound go up on huge volume, end of a rising market, And the very next bar is up on no demand. So that's what we mean by it comes in different disguises. It doesn't wait at all, doesn't mess around. Up it goes, then off it comes. But that's the personality of the pound. And that's what you'll find that these various charts have their own personality. But you'll soon learn to recognize them. I mean, I said to Peter only a week ago, I said, look, you know what your children are thinking because they don't have to speak to you. Because you're so used to them, you know. So he said, well, all they're after money. But I'm just trying to get this. So all you've got to do is 3 principles at the top, right? Doesn't matter what level, you'll see those 3 principles, and 2 major ones, or 3 at the bottom. You've got the one where it dips back down, the volume is low, compared to the previous volume, which was high, say, and therefore that means that there is no supply. The professional money is not selling. And if they're not selling, they must be bullish. So the market automatically follows the path of least resistance, goes up. Then once you're in an up move, the only other signal you've got recognized, which you see, Sebastian sees no end of them, a test in a rising market. That's the third one. It's a down bar on a narrow spread, closed in the middle, volume is low. But you've got strength behind you. Now sometimes you might see a test in the top. But it's not a test because you've got this weakness behind you. And very often you see, if you see a test, and it's a correct test as far as the market's concerned, the professional money, they don't sleep. Market makers, they don't go to sleep. They spot that immediately and they'll buy it. If it's bullish, it'll start going up. But if it falters and starts going sideways, then it's obviously something wrong. Because as professionals, they would recognize that immediately and jump in. Don't forget, most of these top professionals, they trade just like I'm telling you. They recognize the volume, and they recognize how the market's reacting to that volume. You don't see them with computers and all various fancy formulas, do you? They just look at it and they're trading. That's what they're looking at. And as a professional person, that's what you need to do. So there's only 3 at the top and 3 at the bottom. And once you learn to recognize those, everything else will kind of float in. And you will have that knowledge with you for the rest of your life.